Thanks so much for joining us. Really pleased to have with us today Giuseppe Perrone of Varenne Capital Partners based in Paris. Welcome to the show.
Thank you for having us.
Really looking forward to learning from you about value investing. You've been in the business for a long time, lots of experience, and there are, of course, many different ways to go about value investing, and we'll learn from you about how you do it successfully. And before we get to it, it would be interesting to hear how you got started in the business, really what piqued your interest in value investing.
Sure, well, thank you. Well, Marco, my partner, and I started to look at this probably 15 years ago. We wanted to start a kind of a private equity fund, investing in what back then was actually called a venture capital fund. But we realized that it would have been very difficult to get the right size at the beginning. And we started to look at different options. And at some point, I was actually in the United States back then and started to look and understand a little bit what value investing was like. And really, I was in Boston back then. And I started to get to know Warren Buffett and the other, I would say, value investing community there. We started to know as well about Jean-Marie Evelard, which later on became one of our partners. And so we put all those things together and really tried to create a methodology that could have been applied to listed markets, and equities, rather than just applying that to, let's say, the private equity things that we were looking at. And we were really interested in how close those methods were, between this private equity methodology that we were developing and the value investing approach. We thought there was a lot of overlapping, and I would say positive overlapping. So that's how it all began. And I remember in the early 2000s, we were digging into most literature and try to understand how we could make something at the same time effective and a little bit probably unconventional. And that's when we had the typical initiating tour or trip to Omaha. We've been to the shareholder meetings of Berkshire for at least 3 times. We learned a lot back then. And so we started. We started in 2003. We still felt we were not ready, not coming from the investment background. And that's where we decided to act as advisors to a firm here in Paris before starting up for good in 2007.
Now, you mentioned the value community in the US and the Berkshire Hathaway annual meeting. We are sitting here in Paris, and I'm curious just to get your view on the value community in Europe, in France. How do you contrast that to the US? And it seems that there are not as many value investors in Europe. Is that true? And kind of what do you think? If it's true, what are the reasons for that?
Sure. Well, I think there is indeed there's a difference between what you will identify as value investing in the United States and here in Europe. There are value investors here, but generally speaking, value investing is much less well known than it is in the United States. Also for, I will say, simple reasons, including the fact that value has a meaning in the Anglo-Saxon context, whereas here in France, or in Europe, in many languages, value doesn't mean much, if you like. Of course, people in the market start to learn about value investing as opposed to growth investing, but all the I would say the background with Graham Dodd, with Buffett is not there. So you can see that there is this missing link, and so the community is much more reduced here. There are a few very good value investors, but there's not a real public for that, if you like. So I feel that from the community side there is a big difference. So it's probably less mainstream, if you like. On the investing side, I think that we'll discuss probably a little bit later, but I think that the good principles that apply in the United States also apply here with some differences. but they do apply.
And we'll talk about some of these differences in a moment. I'm curious also, you mentioned one of the great French value investors, Jean-Marie Eveillard, the partner in your firm. How did you meet Jean-Marie, and give us a sense of what you learned from him?
Sure. Well, it's of course, it's a great pleasure and a great honor to have Jean-Marie on board. We are the only investment firm which is ever invested outside its own over probably 40 years. And so we're extremely honored with that. And we met Jean-Marie almost by chance. We were looking into finding partners for our firm and really testing the concept a little bit. And we were discussing the idea with somebody here in France, in Paris, who was a good friend of Jean-Marie. And at some point, he said, look, I really don't know much about what you're telling me, but I think I know somebody in the United States who at least can tell you if it's a good or bad idea. And we were pleased to do that. So we called in the United States, and we didn't even know it was Jean-Marie. And after a while, we realized that we were talking to somebody who was extremely experienced, and we felt that very, very quickly. And back then, the only asset that we had was our methodology that we put together for a few years with my partner, Marcus Ormani. And that after talking, I remember it was like a long talk, like 3 hours from New York to here. Jean-Marie told us, look, well, it looks an interesting approach, and if you want, I can kind of back you and be part of this. And we were ecstatic because it was like having this great opportunity to learn from one of the best global value investors in the world.
And I'm sure there are many learnings from that association with Jean-Marie. If you had to pick, what would be sort of one key lesson that you've learned from him?
I think that the single most important is really temperament and attitude. That's really the ability that Jean-Marie has to detach from everything around him, and what he says often refers to as the herd, is very, very important. And we tried to learn from that attitude, which is extremely important, and really in a way it makes you a little bit detached from the market, and that's to us the single most important lessons that we feel we tried to learn from Jean-Marie.
Now, let's move on and talk about value investing. Of course, there are many different ways to go about it. You mentioned Ben Graham and Warren Buffett, different methodologies, if you will. Give us a sense of where do you see the biggest challenge then in investing and in value investing, and kind of how you made sense of it.
Sure. Well, again, this value investing school is, as Jean-Marie said, is a kind of a family, and everybody's got its own different flavor of that. But and this has been a long debate with Jean-Marie as well. Jean-Marie being a lot more on the Graham side. We probably are a little bit more on the Buffett side, without wanting to, of course, compare to the master. But I think that what we think applies as well in Europe or in Asia or in the United States are those sound principles. And the principles that Buffett, in a way, tried to, throughout all his career, to apply in an incredible way. But to us, it's really when he says, value and growth that join at the hip. That's something that, in a way, it remains to us is probably his most important heritage, because we make a difference between, I would say, the value investing school and the value investing masters, in a way. And we think that when Warren Buffett, throughout his career, has been able to invest at probably sometimes at 30 times earnings, that's a lesson for us. Now we really have to understand that sometimes it's better to invest 30 times earning in a great business rather than at 12 in a poor one. And so we try to use that. We think that applies everywhere. What probably, at least for us, has been very important has been trying to, when we started, understand behind the scenes how like Buffett and other masters were investing, and really try to put the accent, the focus on reverse engineering a little bit what they did for so many years. And I remember we really reverse engineered the Buffett partnership before looking at Berkshire, and it was amazing. And I remember we got the wrappers of the partners through somebody who was investing in Buffett partnership. So we had the chance to kind of go through those incredible years. And really what struck us was this ability of Buffett to have several, I would say, buckets, several pockets of investing, which were in a way several sub-portfolios, if you will. And so we try to do the same, and that's the idea of sticking to, I would say, the heritage of value investing. We not only wanted to invest in the longs, in the typical long, in our case, concentrated portfolio, but also use the special situation, the arbitrage, which was a very important part of Buffett and Graham's investing at the beginning, and we felt it was a little bit lost in the value investing school after Buffett. So we wanted to get back to that original conception, and we did by actually setting up a team here that is exclusively in charge of arbitrage, merger arbitrage, and also I would say everything regarding recapitalization, restructuring, which is to us something that is 100% in line with what Graham and Buffett did and taught us over their long careers.
So it's in a way, if I'm understanding that correctly, it seems that yes, one can appreciate just investing in great businesses with great management teams, sort of wide moat investing approaches, but you become a better investor and you learn a lot also by adopting and applying various other approaches that are also based on value principles, but just express themselves differently.
Absolutely, and we think that it is very important to have principles, to stick to those principles. That's the most difficult part of this business. And I will say it's kind of the enemy of the investor is really himself more than anything else, right? And having those principles and sticking to those principles is important. So in our case, we felt it was very useful to kind of have very clear written principles to stick to. And so Buffett, in a way, and Graham provided the foundation. But we also went a little bit farther and wanted to learn from other investors that we found did a great job, like Soros, for example, which is sometimes it seems a little bit at odds with the value investing and Warren Buffett way, to use a term that is well known in the field, but they're not. In our opinion, they're not, and we always wanted to look at different approaches that could be combined. And I think that if an investor has those really marks, and that helps a lot in order to go through very difficult macroeconomic conditions, because we are a generation of value investors that is living a different kind of time than Buffett and Graham, especially Buffett, I will say. We are going through very, very difficult macroeconomic conditions that will probably stay with us for quite some time. So we have to be able to face those conditions, and in our experience, it's been extremely useful to not only rely on the value investing framework, we'll say the classical value investing framework, but also have the special situations which reduces really the correlation of our long concentrated portfolio. And on top of that, actually adding another couple of engines of performance, which probably are a little bit less common in value investing. One being this what we call the macroeconomic hedging, either let's say trades or instruments that really comes a little bit more from the Soros experience. And as a fourth one, the ability to short surgically. So we haven't done much shorting, but whenever we do that, it's a very surgical short. And that's something that's probably a little bit more coming from the hedge fund space rather than, I would say, the typical classical value investing framework. But putting that together, to us, give us the best odds to do well over time.
Now, when it comes to George Soros, of course, one of the investment greats, what have you taken from Soros that has helped you think about investing and being more successful at it?
Thanks. Well, there are a few things there that, and some of them fits nicely in the value investing framework. Some apparently look at odds. Of course, one that fit nicely is the fact that basically there is the investor fallibility, right? We are fallible and as human beings first and as investors later. And this is something that to us fits very nicely with the margin of safety as Ben Graham and Buffett talked about for decades. So that is something that fits nicely together. Some things are probably less, at first sight, at least less integrable. One is the fact that you have the market not only as Mr. Market, as they see it in like in Buffett and Graham approach, but also as an historic process, as I actually say, Soros tend to say. And really understanding the dynamics of a market is something that first is important and second can have an impact on fundamentals as well. That is something that is in a way very much at odds with the idea of just looking at fundamentals, because Soros is actually telling us that fundamentals can be influenced by several, I would say, factors outside the companies, including macroeconomic trends, macroeconomic market situations, market bubbles. And that's something that's probably not very well acknowledged in the value investing framework as it was at the beginning. Now, the reason for putting those two together, I think, is a simple understanding. At least to us, it was really understanding that we are living a very, very difficult macroeconomic context. And this is going to be probably for our generation of investors something very important to take into account into the value investing, I would say, roots that we are extremely, in a way, strict in applying at Varenne. We are very much value investors, but at the same time, we want to take into account those learnings and those, I would say, axes of looking at the market and at investment. And by doing that, integrating the, I would say, fundamental approach, and more than fundamental, the value investing approach on one side, but also the macroeconomic inputs on the other, in order to understand and also answer the, in a way, to the questions: how much is this asset and this business worth, with more than one dimension of analysis.
And now let's talk about how you apply that thinking to the various stages of the investment process. So when it comes to idea generation, how does that help you be better at good idea generation?
Right. Well, all of those, I will say, principles, in a way, to us will be useless without a very structured process. So we try to be very rigorous in the way we generate ideas, process those ideas, and implement those ideas. Well, first of all, we made a decision early on, which was really to, rather say, not to rely on brokers. So we have what we call a brokers are not welcome approach at Varenne. It is completely forbidden to talk to brokers for, let's say, the sell side analysis. It is also completely forbidden to read, I would say, brokers report, the buy, sell, hold on companies. It's something we don't do at Varenne. We do it in a way entirely 100% in-house. We think that adds a lot of value. And we start with the, I would say, idea generation, which adds value first because you're not the 30-second call of the day of a sales person trying to sell you exactly the same thing as everybody else. So having your original screening is important. And that's something that adds a lot of value in our experience. So what we did, just to give you an example, was really to have different kind of screenings. And it took years to build all those screenings together. But some of those are fundamental screenings in which we look at really, I would say, symptoms of undervaluation or of economic quality on a side. And on some others are more on the behavioral side. So just to give you a sense of what we mean, at Varenne, we've built a pretty large database, I would say a global database, 52 countries, by screening of which we can really understand what the people, like the managers, the executives of a company, are doing with their own stocks. Are they buying? Are they selling? Sometimes it's called published dealing of insiders. This is public information, but it really can help through patterns of interpretation to have what we call behavioral screenings, really things that are not probably as conventional as the quantitative or qualitative screenings that you can see in value investing, but it can be extremely effective, especially in shorts. So all that comes together nicely and gives us an original proprietary deal generation. Once you have that, then we also think we can add value by, first of all, reducing the scope of our investment universe. So we never, ever consider the whole list as the investment universe for us. We try to probably, I would say, cut out no less than 50% of the market. So if just taking the example of we have typically had a concentrated portfolio. Sometimes in some of the most concentrated funds, we have 10 securities, 10 holdings. We couldn't have 10 holdings of, I would say, very unpredictable businesses. So we try to cut that out of the selection early on. Everything that has, like technology risk in it, it's entirely out of that 10 holdings and cannot be part of that. If you look at capacity industries, if you look at real estate, that is not part of our selection early on. So that, in a way, reduces the universe and makes it safer. So within that safer, much reduced but much safer universe, we are comfortable building our very concentrated, very focused portfolios. So we think that adds a lot of value, not only in the fact that you get your top picks, but also because, in a way, I don't want to say we are more precise in answering the question, how much is this worth? But I would say we are probably less imprecise or non-precise in answering the question, because it's always an estimate. It's always value of a company, answering the question, what's this asset is worth? It's always an estimate. And if you put Marco, my partner, and myself into different rooms, you will come up with different figures. So that's, by definition, an estimate that I like to say it's wrong by definition. And we have to be aware of that. On top of that, we look at companies also on what we call the economic quality side. And it's something that is probably a little bit different from what you have. Typically, it's not quantifiable. But we found a very simple way of creating a rating, which is pretty much like the credit rating, which we have the A, B, C, and other ratings that we can assign to a company after due diligence. So instead of simply answering the question, how much is this business worth, we also answer the question, what's the economic quality of the business? And that's very important, because with the best economic quality, you actually can expect very significant returns on capital employed or return on equity capital over an extended period of time. And that's, in a way, the quote-unquote the holy grail of value creation. That's really the grail of value creation. And that's where I think for those businesses, you have to be aware of that before discarding them because they're too expensive, and also before selling them too early. Give you an example, which is not something that we have done, but I think can really give a sense of this. If you take Walmart in the United States and you are in 1979, well, if you think about what Walmart has done over like 25, 30 years after that, and then go back with a DCF, for example, how much was Walmart worth in 79 earnings? Maybe 150 times 79 earnings. But there's no model, especially no value investing model, that is going to tell you this is worth 150. So that's why we think that there is a lot that actually is not, in a way, captured by the financial models and let's say the value investing, typical value investing method of investing. That's why we also have this dimension, which is looking at companies throughout their economic quality and assuming that whenever, as long as, if you like, a company remains an A for us, an A-rated business, like the Coca-Cola for Buffett, of course, this is going to deliver above average economics. And that's where we want to treat the business differently from a B-rated business. So we just give an idea, we're happy to pay even 20 times earnings for that business, but we are very unhappy to pay 15 or 12 for a B-rated business, if you see what I mean. And that's where the equivalents get together. So just to give you, so this is the way of putting approaches that apparently may look a little bit at odds together in a very harmonious way. And we're great believer in this, just trying to put together best practices in a harmonious and rigorous way. That's what we try to do.
Let me just ask you then, of course, this is not easy to do in practice, and often of course, the great businesses such as the Coca-Colas of the world, they do come expensive optically to a value investor, perhaps not trained in some of these other approaches. So give us a sense of how do you then distinguish between, let's say, great businesses and merely good businesses?
Right.
How do you do that?
Well, that's the key. I mean, if you go back to the example of Walmart, in '79 probably Walmart was, I remember it was around 16 times earnings. If you take a regional chain, it was probably a 13. Now, a financial analyst, will see the difference in that way, but a business analyst, and I remember Buffett often referred to his work and to himself as a business analyst. A good business analyst should see the difference between the two. You will never be able to tell you this is worth 150 because it's also a function of what happens next. But at the same time, you really have to kind of X-ray that company and try to figure out why this company is an A-rated business and the other one is probably a B-rated business. Now, the way we do that at Perrone is really trying to use a very consistent method of kind of X-raying the companies. And it starts with what we call the competitive advantage. We want to see sustainable competitive advantage that we can measure. And measuring competitive advantage comes down to, our approach, looking at two sides, I would say, of the equation. One is the costing power. I mean, the ability to produce goods or services. Like if I take, this pen here, I have to be able to produce this pen at a unitary cost that is, less than my competitors. If I can do that, and if that is sustainable, it gives us a huge advantage, a huge economic moat. And in our approach here, we call it costing power, which is something that probably is less well known than pricing power. Everybody talks about pricing power, but costing power is a very powerful source of economic moat. Of course, we look at pricing power as well. Pricing power has to be is the other, I would say, side of the equation. You can see pricing power as the ability not only to translate cost inflation to your customer, but also to extract premium prices from your customer. And in doing that, you have to really understand what the business is about. And we mentioned at the beginning, or I don't know if we did, but one of the influences that we had at Perrone was Michael Porter. Michael Porter, Professor Porter, Harvard professor, created extremely powerful tools for analyzing businesses, being the five forces, probably heard of, or the value chain of analysis that really allow us to understand when and where the perceived value for the customer is created. And by doing that, we really managed to have this understanding of and comparing the companies to its peers, understanding whether this company is at an advantage or at disadvantage in any of those activities. So that's very helpful. That can be done by anybody, not just by professional investor. Just anybody could simply use those very simple tools to understand whether a business has an advantage or a disadvantage compared to its peers.
What do you think is the biggest challenge with that approach? Often people will say when it comes to deep value investing, the challenge is, of course, presented by these so-called value traps. And now when we think about the other side of the spectrum, what do you think is the biggest challenge when it comes to the situations that you were just describing?
Sure. Well, the value trap is a real risk, but the value trap is in a way it's not a value trap in itself. It's just the fact that basically behind that stock or the security, there's probably a business that is going nowhere in a way, and that's where I would say the valuation or the financial security analysis is probably not enough. You need to have more than simply. You need to have the business analysis to get it right, and that's to us it's very, very important. At the same time, the other is just in a way looking at business without taking the financial dimension into account. Actually exposes you to the risk of overshooting in a way of like going into growth territory, if you like, and that's something that is at risk as well. So it's a real balancing act in a way. Sorry.
And do you think so? Do you think it's a bigger challenge to identify the great business from the good business, or is it the bigger challenge for an investor to overpay or not overpay? So is it an issue? Where do you see yourself when you look for these types of situations? Is it harder to identify really, is it a great business, or is it do mistakes come from overpaying?
Yeah, but you can see that in a very easy way. Basically, your opportunity cost is probably on one side, and your risk of, let's say, or your downside risk or your risk of loss of capital is on the other. So it's a balancing act. But if you're missing Google, for example, you probably miss your opportunity cost of doing something like going into a value trap instead. It's huge. At the same time, if you are overpaying for a technology company, you have a massive risk of losing capital. So it's a balancing act. And I was mentioning Google just because we know a little about this company, but simply because some business have built a competitive advantage. That is the case, in our opinion, of a company like Google over time. I'm not talking specifically now or tomorrow, but over time, they've built competitive business advantage, not just technology advantage. A good analyst should see that. Now, that's the reason why we came to the conclusion that it's very hard to quantify that. And so we, in a way, settled on the idea of actually giving a rating to those companies in order to compare what's comparable. It's because it's probably the only way, at least the way we see, to take advantage of that very important information on the side and really, in a way, have these two dimensions, separate dimensions. On the one side, we look at the economic quality and in a way, the perspective that we have for value creation. And on the other side, we also look at valuation, and we try to build a model where we try to optimize and maximize, if possible, the average discount to intrinsic value, but taking into account the quality of the assets of the portfolio and knowing that not each company in the portfolio has the same economic quality. It's not perfect. It will never be, but it allows us to kind of have a meaningful and rational portfolio creation activity, portfolio construction, if you like.
And we'll get to portfolio construction in just a moment. I'd just be curious when it comes to these businesses like Walmart back in the early days. What are some of the valuation methodologies? How do you then get comfortable to even approach valuing such a business? What are perhaps some tools that you use?
Yeah, sure.
Do you use a DCF, or what do you use?
We don't use typical DCFs. We use a little bit. We're very fond of the idea of being approximately right rather than precisely wrong, and we use very simple tools for business measure, for answering the question, how much is this business worth? But we also make a difference between, I don't remember, I mentioned before, an A-rated business and a B-rated business. The two are not, in our approach, valuable or valued. They shouldn't be valued in the same way. In an A-rated business, we take a longer-term approach than probably in a B-rated or in a turnaround business. So in an A-rated business, we kind of look at the average coupon, to use the term that most value investors know. And it's a great idea. I mean, it's really trying to understand what the free cash flow that we can extract from that business 3 to 5 years from now. But then, and that's something that we learned over time, we didn't do at the beginning, but we also use a kind of correcting factor to take into account the long-term growth potential of a business. For us, it's something that remains very, very cautious, never more than 3%. So even if you take the Walmarts of the world, Nike, a business that we have invested in for many years in the United States, we always say, we try to pick between 0 and 3% to correct the value bias that we have structurally in the 3 to 5 year coupon. So when we do that, it doesn't seem huge. It's 0 to 3%, and the best companies get 3. But if you take that into account, like for eternity in a way, that makes a huge difference on the valuation. So that is something that we have found to be useful in correcting the value bias.
Now, if we go toward portfolio construction, then you've alluded to the concentrated nature of your portfolio. Give us a sense of the thought process there, 10
Sure.
positions versus 20 of such great businesses, or even 50 positions or more.
Well, we are great believers in the fact that if you want to add value at a portfolio construction level, so after you generate original ideas, you make very thorough analysis, then you have to be concentrated, focus on your best picks. That's what makes the difference. Otherwise, you're just averaging out. If you take more than 20 stocks, at some point, there's no way with equal weighting maybe to go and do much better than an average investor. So we think that adds value, but we also think that's a risk. So there's not just one way of doing that. But if you think about the two dimensions, which is the undervaluation on the side, the discount intrinsic value, which is a powerful engine of performance, and the economic quality on the other side, there is again not just only one solution to that equation. So you will see that we have seen some excellent investors doing mainly just, I will say, the discount intrinsic value, and you can get maybe with a little bit more of turnover, very undervalued securities, take them in your portfolio for a while, and then sell them and buying another one, and just kind of turning over, not very frequently, but still maybe every 18 months, and so on and so forth. That's a way of having great results, great returns for investors. And there are other cases in which you can get pretty much the same returns by sticking to a great company for maybe 10 years, as the Coca-Cola example is of course a classic, and just trying to extract that big advantage of joining a great business for the long run. That both works in a way, and so in our approach, it's really a matter of price. Really have to make the difference between at what price, at what, if you like, price earning, just to make things simple, an A-rated security equals a B-rated security, and that's not an easy, answer to have. So in our approach, we like to see it like under valuation level. So whenever, basically, we always buy an A. We always prefer an A, because if it's an A, where our models, remember the example of Walmart, will tend to undervalue the companies over the long term. So we always buy an A unless the B is much more discounted. So whenever you're in a way on the value side of the equation, you have to be really on the deep value side of the equation. But if you are on the economic quality, you have to understand that your financial model is probably not the best metric to look at. So that's why we say, in a way that we can propose and we have used for quite some time, and we have tried many things before getting there, is really to say, look, finally, a Walmart, a Nike, an Inditex here in Europe, they are great companies over time, and as long as they remain an A, we have to stick to that. But sometimes an A business company, if you like, doesn't, for reasons that may be industrial, it may be management or anything else, they lose that kind of superpower. And that's where we have to acknowledge, and then really acknowledging that allow us to, in a way, take into account the fact that the business probably will not deliver above average returns over time. And in that case, try to see whether we have something better within our watch list to take the place of that company. So that's something that can be done, again, by any investor with a little bit of discipline.
And if you do find a B-rated business where the share price is such that it allows you to see it as an interesting opportunity, just like the A-rated business at a price that's at a valuation that's higher, are you still comfortable, let's say, putting on a same position to the A-rated business?
Well, we don't. I mean, it's a great question because we always have a preference for the A-rated. So we will, in some of our funds, we will see that the position for everything else being equal, we'll take on more. Basically, we will have assets under management of, let's say, 10% to an A-rated security, allocated to an A-rated securities, whereas it will be 6 or 7 to the B-rated security. Actually, to be precise, it will be 11 to 7. That's what we use at Perrone. And that's because we always try to be aware of the fact that as long as the business remains an A-rated business, it will compound, I would say, returns at a very high rate. And that's something that over time will be a source of returns as well for the investor that is not fully taken into account by the financial metrics, by your valuation model, if you like. So there's always something that you have to be aware of. At the same time, you don't want to go too much on the growth side, because then you expose it to the risk of loss of capital, of market fluctuation. And so that's why we think, again, it's a balancing act. It's not perfect, but it allows us to make an equivalence at some point and say, like, a B rated at 6 is probably equivalent to an A rated at 16. And that's really where our model allow us to say, okay, shall we go for this one or for that one?
And just to be very clear, and again, we're not going to get into anything precise here,
sure.
But just to give us a flavor for your thought process there, and I guess how different people will perceive rated businesses rated A differently from B, rated B. So is there a good example of, or just give us a sense of perhaps some business models that you think are underappreciated by the market, where the market thinks it's a B-rated business, where you think it's A, and perhaps vice versa, just to give us a bit of a flavor for...
Without getting into a great level of detail, and I probably, if you'll talk to my partner Mark, we will, but it's like sometimes there are situations which are either related to a business or to a market, where some businesses are, for a reason or another, out of a favor with the market. So just an example, we have invested in a company that was in Asia, in Hong Kong, which is called Magic Holdings. Magic Holdings still is a company that has approximately 25% market share in a business we don't know much of here in Europe. It's the facial masks. Facial mask is cosmetics. Again, I don't want to go too much into that detail, but just to give you a sense, we bought the business for 12 times earnings, and we really consider that to be an A. And the nicest thing was that not only we had the 12 times earnings, but also we had 1/3 of that 12 that was actually net cash. So we had this great financial position, so giving us the business net, I will say, for single-digit price earning. Now, this is something that is bizarre, because when you look at that, and we go through our criteria very quickly, you have great costing power. This is 25% market share with fully automated lines, 300 million units per year that can be produced there. You have great management team, which is, by the way, something we haven't touched on, but is the single most important element that an investor should look at when investing in a company. You can get the best company in the world, but a management team that is inept will destroy that at some point. So we always have, and maybe it could be interesting to touch briefly on that if you have 5 minutes. And then the perspectives. Look at this. This is probably the fastest growing category in cosmetics in Asia and in China in particular. By the way, L'Oreal, a few months after we did, bought this company out. But again, the point is really Mr. Market, and then we go back to Mr. Market, if you like. Mr. Market is in different moods, and in respect to that company, it doesn't make the difference. So the market doesn't really make the difference between a good company, great company, and an average company. An analyst should do that. That's our job. And that should be like doing the homeworks, in a way, as Buffett will say.
So in your view, this company was an A-rated business, just the way a Coca-Cola would be an A-rated business?
It's always difficult to say. This is a much smaller company, but if I give you an example like of that magnitude, you can think of Nike in 2009. I mean, this company was actually extremely cheap back then, and the market was, in a way, in a mood that actually was throwing out of the windows great companies, and basically the pricing of those companies was very similar to what a B-rated security should look like. So yeah, it's a lot about really what the market is actually giving you as an investor, and you should use the market. I mean, that market should be used as a pricer, nothing else, nothing more. It's not you're not right because price goes up, you're not wrong because price goes down, but really use the market as a pricer for you. Are you willing to buy that? Are you willing to sell that at that price? That's the only question. So that's really what I think about that.
Now, if we leave price considerations aside for a moment, give us a sense of what's, in your view, a business that should get an A rating, where perhaps the market thinks it's a B-rated business, and vice versa. Give us a sense for that grading system.
Oliver, that's impossible, because basically you should know what the market thinks, and that's something that we cannot do. And so I don't think I can answer that question. I can tell you about companies that we think and feel strongly they are an A or a B, if you like. I think of Nike, for example. Like in the case of Nike, why do we think this company is an A? Because, well, they have costing power, pricing power, great management team, and favorable, I would say, excellent long-term perspective. Like, look into the first. Costing power is something that you have to assess at unit cost level. Nike is probably the only company in the world, with a little bit with Adidas, but at much lesser level, that is able to pay, let's say, Roger Federer, tennis player, $50 million per year, and then have those $50 million per year actually going into a very small, I would say, part of that sponsoring into every single pair of shoes that you're actually going to buy. And you have to have the volume to get that kind of competitive advantage, because every single pair of shoes will absorb a very tiny fraction of that sponsorship. That's costing power. Nobody can do that. Adidas can try, but Puma cannot, for example. Like that, just to give you a sense, Puma, very well-known brand. In terms of figures, the turnover, the sales of Puma are in the same ballpark as the promotional budget of Nike. They don't have the volume. It's probably 1/10 of the volume of Nike. So they cannot compete with Nike on the performance market. And that's why they try to do something on this lifestyle market. It worked for some time. Now it doesn't work any longer because they have to go into facing Nike on their strength, which is the performance. Of course, there are Under Armour, there are some other, I would say, very good companies that are trying to do something there as well, but we all know that's very, very difficult. And that's the costing power we look at. It's a different kind of costing power. It's not just about the volumes, the production cost, but it's also costing power, and it comes really at unitary cost. Pricing power, well, we know, example of Nike, they have sometimes 65% market share in some categories. That's a huge bargaining power vis-a-vis their clients, which, by the way, is not you and I, but it's really the large wholesalers and retailers in the world. Management, this is a management team that has been there forever. It's been there for since the 70s. They are very knowledgeable about the company, about the products. They have the right strategy, and that's also a very important thing. How do you actually value a management team? Very difficult, very, very difficult. So that's why, in a way, we tend to use 3 simple tests. The first is the strategy. Do they have the right strategy for their company? Yes or no? And it's binary. It's either yes or no. And if yes, do they have the ability to execute the strategy? That includes things like competencies. They have to have the right, people. They have to have the right financials, the financial resources to execute the strategy. And actually, what we will do, the third point, very, very important, will be to look for a track record. Just like choosing a manager, we will look at track record because that's where we want to have a confirmation of our answers to point 1 and 2. Those are the things that, for example, in the case of Nike, are 1 and 1. They have the right strategy for this company. It's a premium strategy. It's not a discounting strategy. They keep nurturing the brand with the incredible marketing and promotional activity, which, by the way, costs in the billions per year. They have the ability to execute the strategy because they've been creating second and third level of management within the company for decades. And their management is today just a reflection of, I would say, of that effort. And you can see that at any level, the company strives for excellence. And third, we think that they have the track record. They've been delivering for many, many years in very similar contexts to the ones they're actually in right now. So just to give an example, this is very, very important. And the long-term perspective, of course, in the case of Nike, just think of basketball in China. And of course, we don't have time to go into all of that, but they are very, very good.
So if we take that industry and kind of think about the rating system, then Nike would be an A.
Yep.
And on an absolute level also compared to Coca-Cola, let's say. But Puma and Adidas, in your view, would not get the A because...
Because actually, in the case of Adidas, they have very similar volume, but they don't have... they have 2 brands. They have Adidas and Reebok. So they split that volume not exactly in 2, but they are split in 2 brands. And we, with all respect to the management of Adidas, we much prefer the management of Nike to the management of Adidas. The management of Adidas actually, they have made a few mistakes in the past, including the Reebok acquisition. And we think that probably they haven't deployed capital as well as they should have. So that's why we don't rate, we could never rate a company where we don't entirely trust 100% the management team action. And in the case of Puma, that's a good example. There cannot be really an A simply because there's no way it can compete against Adidas and effectively against Adidas and and Nike, and that's the reason why we will not expect the company to deliver above average returns over time, like good return on equity and good returns on capital employed, because they are not in a position to do so for quite some time.
Let me just jump in there, and you talked about the importance of management. So I'm curious about, obviously, there's the other view which says, actually, I think you said that great management and great business kind of goes together, and you cannot have a great business without great management. What about that other view that says that ultimately, I think it was Warren Buffett who said that you should find a business that even, if a monkey runs it, it will be fine, because eventually a monkey will.
Yeah, that's a very good one. Well, they're not incompatible. You have to get a business that has a competitive advantage, and that's really the premise, I will say, the way we look at things. But at the same time, management is extremely important, and also Buffett mentioned several occasions that how important it is to have a rational management team. I mean, rational is probably an understatement, because basically you can have rational or very good or exceptional managers, but at least rational management team means that it will not destroy the advantage, the moat that the company has built over time. A good or excellent management team will probably create or make that moat larger than it is today. And we try, of course, to have at least a good, let's say, rational management team. But if we can get more, that's where we fundamentally believe, strongly believe, that a management team, the men and women that run a company, they make tens of decisions per week or per day in some cases. And those decisions will compound just as the allocation of capital will into either, let's say, good allocation of capital and creation of value, or bad allocation of capital and creation of subsequent creation of value, destruction of value, I should say. So that is very important. So that's why we think the management is the single most important aspect of investing, and we should not underestimate that.
And I want to pick up just on one thing you mentioned with Nike. You seem to have stressed the importance of a premium pricing model, not discounting. Mm-hmm. Can you give us a sense, why do you prefer that? I mean, Walmart has, as you mentioned, has done kind of the opposite, focused on the discounting and made a successful business out of it. So is there a struggle between the two? Do you have a preference?
No, absolutely not. We don't have any preference. What I was trying to refer to is the fact that they have the right strategy for the company, and all the value chain they have created and put together is consistent with that strategy. Give you an example, Inditex in Europe, the Zara franchise. This is a discounter. We've been investing with this company for many, many years, close to 10 years. We actually, I think we got more than we ever thought out of this investment. But this is a discounter. Then what is important is that the strategy is right for the company. All the value chain is built in such a way to be consistent with that approach. They have larger shops than anybody else. They don't have any advertising. They have the most efficient logistics in the world. They have huge purchasing volume, and so on and so forth. So all that combined allow the company to be a cost leader. And being a cost leader is what you want to be, where you want to be, if you have a discounting strategy. In their case, we could call it fashion discounting. So we love that as well. What we don't like to see is a mixture of the two, where you will have the same production factors, like premium. Let's say that we have a premium company with a premium strategy and the discounting company, but both of them share the same. For example, they have the same. They pay the same rents. They have the same kind of shops, and so on and so forth. basically the second one will be only, in a way, passing to the customer its own margins. And that's something we don't want to see. So that's why we say, if you want to be a discounter, that's fine with us. Actually, we love that. We've been investing in many discounters over time. But the strategy has to be consistent with the value chain of activities and has to provide, at the end of the day, a competitive advantage. It's rare to have both. The example of Nike, it's a rare example where you have both costing power and pricing power. But even Inditex, for example, they are able to have a little bit of pricing power because they have a fashion value proposition to the customer that probably H&M doesn't have. You see what I mean? So, or having probably not at the same level of intensity. So that's important as well.
But the danger, of course, with Inditex could be that the management starts to think that they could have a lot of that pricing power and start to base that strategy on that, where it would, over time, perhaps lead them astray from their core competitive advantages.
That's always a danger. So that's why we say, as long as a company remains an A, because, there are many, many reasons why a business can lose that kind of superpower. And it's our job and the job of any investor to it's supervise in a way or look after that and see and recognize at some point whether a business remains an A or at some point becomes a B or unfortunately a C, which in our jargon is non-investment grade, if you like. So everything can happen for a business to lose its, and sometimes it's just a matter of headwinds, if you like. It can come from an industry evolution or revolution, from a new entrant. And that's why, in this case, the Michael Porter's tool are extremely useful in monitoring the industry and not only the business, if you like. So there's nothing that you can keep for granted. And also that's a good reason why we prefer to have this kind of test that is not just assigning an A after the due diligence that we carry out, but also doing this test constantly to check whether there is some new elements that should imply that the company is not an A any longer. And that's something that, as long as the company remains an A, we will expect above average returns. If it's not an A any longer, that kind of superpower just goes away.
Now, I do want to come back to portfolio management, as we discussed earlier. I'm curious, with the methodologies that you talked about, also looking to not just Warren Buffett, but also George Soros, and thinking about the elements that one can take from that into one's portfolio. What does shorting do for you? What are some of the macro hedges or special situations? Why do you do that as a value investor?
Yeah, that's a great question, and we have been asking that question to ourselves for quite some time. If you take them one by one, I think that any company is actually something that you can see, an entity you can see within a macroeconomic environment. And you cannot really say that the company is immune from that macroeconomic dynamic. Those macroeconomic dynamics are going to impact the company. So we try to look at those dynamics, and we see at the moment and for the foreseeable future some possible headwinds that could be at some point problematic. So when we see that, and when at the same time we look at the portfolio and we see that there are some risks that we are not able to deal with through cautious portfolio construction, and again, we discussed a little bit about the fact that we exclude probably 50% of the list, and we try to stick to very predictable businesses, but even those very predictable businesses cannot be considered immune from, let's say an example, a global economic recession. I don't want to talk about depression, but let's talk about a recession. So that's something that we still think is very possible, and that's why there are some either, I would say, asymmetric trades or asymmetric instruments that can be used to protect that, risk over time. We have never been fond of, precious metals. We have never done anything on precious metals, and some of the value investors use, including Jean-Marie, gold as an insurance policy. We don't think, it's a difference between Jean-Marie and us, that for what we are looking at for the foreseeable future, that could be a good protection. And we try to use the industrial metals. So, for example, if you think of copper, copper is the single most, correlated asset to economic activity. That's why we like to, when it's possible, to buy some put options on copper in order to protect the downside of the portfolio that goes behind the simple, the normal economic cycle. So if you have something that's a kind of tail risk event, then our put options on copper will help us in reducing the losses of the portfolio. That's why we do that. Of course, we do that when everybody is happy and bullish. We try to do that when there is optimism in the market, and that's when, generally speaking, the volatility is low enough to allow us to insure a pretty large chunk of the portfolio at decent cost over time. And just on this, it's not something we do short term. Whenever we buy an option, we buy long term. Something to be interesting to discuss another time. For us, buying an option is always a long-dated exercise. If we sell an option, then we want to be within three to maximum 6 months. But anytime we buy, it should be more than 18 months.
So the use of these other securities or approaches is really to protect the core portfolio of great businesses, largely great businesses, against these tail events. That's
for the macro hedging. For the shorting, shorting has been something that we have been discussing a lot, and as value investors, it hasn't been an easy decision to allow us to do that. We haven't been doing that lightheartedly, but we feel that, again, going forward with the macroeconomic challenge that we have, the only way to protect the capital of our investors over the long term will be to be able to have different, engines of performance, and so different configuration to go through those turbulences that we think we will have. So we think that there will, especially if we have a different scenario, whereby you have the interest rates, for example, at a very high level compared to the low level that we see today. In that case, a lot of businesses that we think as let's say, average business today will come up, and we will see that they will not be sustainable business any longer because simply they embarked into too much debt. So in that situation, always looking at capital events, which is really what we look at as shorting, so situation where you have the risk of, I would say as a minimum, a recapitalization, and as a maximum, a bankruptcy. So this very, very difficult situation, we can try to put on a strategy that allows for a capital protection combined with all the rest. And an example of this you can see in 2011, where in the second half of 2011 there was some turmoil in the market, and even we in our portfolio we've seen the enterprise peaking, the long part of our portfolio going down, not as much as the market, but still going down, and the other two being special situations and macro hedging actually compensating for that. That's something that is for us is a good proof of concept that this works.
Now, we discussed obviously the core philosophy and then the various strategies and the approach that you employ to be a successful investor. I'm curious, of course, there are many ways to get distracted, to do many things. Give us a sense of how you ensure that you stay disciplined, even if you, let's say, use options to express a view as opposed to equity and so on. Give us an example of how you stay disciplined but open-minded about a lot of different methodologies and instruments.
Okay. Well, I think that's again, it has to be part of your strategy, your methodology. Just to give you a sense of how we work at Perrone, we like to see the strategies as investment frameworks. So basically, each framework, once complete, has to have several parts that need to work together. So the first is to have a methodology. You have to have a methodology, which means that you have to have the analytical tools and the investment principles that are needed to execute the strategy. But then you also have to have a process that makes the strategy work, an information system that is supporting the process, and a dedicated team of people that are able to make the whole thing work. So that's really within one framework. Now, the other thing is that how do you get those frameworks together? And that's what I call the articulation of the strategies, and that's really the portfolio construction. Now, if you refer to instruments, they are part of each of those frameworks, and they can help if used properly. And there is this long debate about derivatives. So are derivatives good, bad, weapons of mass destruction? So again, Buffett used them. Buffett uses derivatives, although at the same time he defines them as potentially dangerous. So as always, it's a matter of how you use them and whether you are in control or not. We try to have a usage of derivatives within each of the frameworks that we employ. And within that, in a very controlled way, we can make or take advantage of some of those instruments to, for example, in enterprise speaking, find or let's say find an asymmetry in risk-reward, not through the underlying asset, but through the instrument itself. So just as an example, we have had for some time very long-dated options on Google, which can be surprising. If you think that we don't invest in technology, we don't take technology risk, but we do think, and without entering into the details, that Google has built a fabulous economic business competitive advantage. Now, the only thing is that sometimes we are at the frontier between what we can do and what we think we can do, but we see some risks that we don't want to take. And in the case of Google, the main risk will be a disruptive technology coming in. Now, if a disruptive technology comes in, then Google could be affected at least in some part of its business, and the technology could be a different way of viewing the information that is probably not conveyed by internet, something that we cannot think of today. So with that in mind, and only when there is a real, a clear relationship between the upside and downside, in the case of the options, for example, in enterprise speaking, we want to see an a potential upside of at least 3 times in order to use an option instead of a share, a stock, which is, of course, very different from the 2 times that we require for the shares, for the stock. So if we are correct, and if we were correct when we purchased those stock options, Google should be worth 3 times the price current price. So that is something that allow us to, in a way, express our view, invest in a company like Google without taking the full risk associated with the purchasing the shares outright.
Now, there are many strategies in your approach, in your thinking. Give us a sense of how that all fits together when it comes to portfolio constructions. How do you put that all together to really help you achieve superior performance over time?
Sure. I think that there are many ways of adding value at portfolio construction, and we are very much convinced that there are at least 2. The first is really to pick your best choices among a watch list of many, without being in a way compelled to equal weight your portfolio. That's very important because that will make above average return if you're right. Also, you were referring to different strategies. For us, every strategy has got its own framework. So it's an investment framework. For us, once it's complete, it's got its own methodology. And for us, the methodology is really the analytical tools and the investment principles that are needed for the strategy. Then you have to have a team. There's actually a dedicated team that is able to execute the strategy, and an investment process that actually lead to the result that is what you want to have, and an information system that help the team go through a very large amount of information. So once you have that, basically you also have an investment within the investment framework. You also have the portfolio construction for that framework, which means that within enterprise picking, in our stock picking, which is the core of the portfolio, we will know exactly how much to buy and sell of any single security for any of our portfolios. The problem is when you have to put them together with the rest of the strategies, and that's where the global portfolio construction model comes to help. It depends really on the different strategies. But just to give you a sense of that, on the macro hedging, we have a budget. We have a budget that we don't want to, in a way, exceed in order to make it cost effective. Whereas on the which is very low in the single digit, I will say, percentage of assets under management per year. Whereas in the longs, we have a much larger limit that we have, which is close to 100%. So they are really the essence of our portfolio. On the special situation, if you consider that these are very short-term plays, sometimes between 30 to 90 days. In that respect, as Mr. Buffett did with the Buffett partnership, we are happy to use margin financing. We are happy to use some leverage, if you like, for that very short period of time on very safe deals or investments or trades. If you think that these are only friendly announced deals, and for most of them cash only rather than stock for stock deals, you can get a sense of how conservative we are in that respect. So that at the end puts together the structure, and that's something that comes from Soros as well. Soros used to say our fund, referring to the quantum fund, as a structure. With the pillars and then something that you put on top and on top again. Well, it's the same for us. We are the main pillar of the fund is the concentrated long portfolio. On top of that, you have the special situations, which can be again on margin when it's needed, and on top of that, you have the macro hedging, whereas the shorts are within the enterprise picking. So that's the way it works.
And so there are these strategies that you have, and then let's talk about the instruments then to express certain views. Give us a sense of even how and when you would use derivatives.
Sure. That's a great question. Every single framework has its own, I would say, instruments that you can deploy. So we can use cash equity for enterprise picking, but we also sometimes rely on options. So there's always this debate about whether it's it's a good or a bad thing. And if we go back to Buffett, he used to call them weapons of mass destruction, but he's been using derivatives a lot at the same time since selling put options on Coca-Cola I guess it was in the 70s. So in our case, we tried to stick to a very conservative, though very, I would say, predefined framework every time we rely on derivatives. So just to give you a sense, sometimes it is better for us to purchase a long-dated option expiring 3.5 years later than when we bought them, and that's an example that I have on Google for just to mention a company that we have in the portfolio. And to give a sense of this, we paid 10% of the then price, then current price, and that gave us the possibility to keep this option for 3.5 years with an economic interest in Google shares, while at the same time, without, I would say, at the same time, putting the capital, the 90% capital that was missing in a way into that play, reducing the risks, and at the same time using the 90% in very cautious, predictable, kind of boring long-term investments that just with their dividends will finance the 10% they were actually paying for the Google shares. Now, without entering into details, Google is a company that, in our view, has created a very significant competitive advantage, large moat. It's not just technology, it's much more than that. It's really business advantage that they have. But we still feel that there is a risk, a residual risk of a disruptive technology coming in at some point. It might not affect the all of their business model, but part of that. So that's why we don't feel comfortable enough, even understanding that I would say the big moat that the business enjoy. We are not comfortable enough to buy a stock. In that case, only when, and if and when, I would say the price is right for the options, which was a few months ago, we rely on that as in a way as a surrogate for a stock, and that works pretty well if some criteria are met. Just to give you a sense again of this, we only buy long-term, long-dated options when, in case, of course, our analysis is right, the value or underlying value of of the assets equals at least 3 times current price, and that's a much stricter requirement than a cash equity. I would say cash equity stock that we will buy. In that case, we will ask for a 50% discount to intrinsic value, which means that you're actually asking for the stock to be worth twice the current price. You see, it's a very different hurdle that we're using, but that makes sense because we are actually need that kind of very large upside. Although maybe there could be some more downside as well, but we are not taking that downside because we're buying an option. And you also need to have a price that makes sense. And there you can see the value investors in us. We don't want to overpay that option. We want to have a good, very interesting, I would say, price. In the case of Google, 10% over 3.5 years is not that much if you can use the 90% that you are not putting into that into another I would say, investment.
Now, of course, that structure and the different strategies, as well as the use of various instruments to express these strategies, you do that globally, which is, again, another dimension. Some investors tend to focus on a region and so on. You have that unconstrained ability to look globally, which can present also some challenges. And I'd be curious if we can talk and just focus on Europe for a moment. We are here in Paris, and a lot of investors will struggle when they hear about, let's say, France and the opportunity set in France, or let's say even further south into Italy, or there's this notion that value investing doesn't work in Europe for various reasons. It could be family-controlled companies, governance issues, and so on. What's your experience been? What do you think is the biggest challenge or the differences in applying your philosophy? What do you do perhaps a bit differently when it comes to Europe?
Well, Oliver, the universal principles the principles of value investing they apply everywhere. They are universal principles, as I was saying. So we don't see any difference in that. The main difference is probably in the shareholding structures, and they are much more closely held here than they can be in the United States. So if you are a value activist, which we are not, then you will struggle here in Europe because you will have a much harder time into trying to make change, in trying to cause change, I will say, change management teams and so on and so forth. So that's something that we don't do here, and it wouldn't work as well as in the United States. At the same time, as an investor, which is mainly passive in our approach, we tend to prefer a situation where even though you have a family sometime, you have to have some counterweighting power. And so you have to have, for example, a management team which is really in control, at least of part of the business, and maybe with some significant stock option plan, which in a way creates an interest and a say for these people vis-a-vis the founding or the founder's family. I have some examples in mind, thinking of LVMH. You have one single large shareholder, but you have a management team which is, first of all, of great quality, and also very much invested in the company through stock options plan in the tens of millions. So that makes very difficult today for Mr. Arnault to, in a way, make decisions that could be unilateral or favoring, if you like, the major shareholders and be detrimental to the minority shareholders that we are. So we always try to be on any situation, and even in the United States, if I think of China or Hong Kong, to be precise, we have invested in a company called Endeli. Endeli is the largest retailer, wholesaler retailer in the world of Swiss watches. When you invest in Hong Kong, you have shareholding structures, background checks are fundamental. One of the reasons why we feel comfortable in that investment is even though you have a shareholding family with 35%, approximately 35% of the stocks, you also have LVMH and Swatch Group from Europe that have a strategic stake each into the company. And in the case of Swatch, they also have a representative on the board. So that makes for a counterweight, you see what I mean? That allows us to be a little bit more comfortable with the idea of having just one single family. When that is not the case, it's even better, because basically when you have a few families or different members of the families, or a group of management together, that's probably the best you can have in terms of governance. And we really are very serious about that. So basically, we don't like the one single dominated shareholders on the side, but we also don't like the public company on the other, because when you have a public company, then basically you are at the mercy of the management team, and nobody can really have or kind of a supervision, an oversight, I would say, on what the management is doing. So we always try to be somewhere in the middle between those two extremes. And even in Europe, you can find situations, as described before, that can work pretty well. But you have to be careful. I will say you have to be careful everywhere, not just in Europe. But in Europe, it's true that you have, generally speaking, more closely held shareholding structures.
And it's interesting how you brought in the example of Asia as well. And so it seems that the two, Asia and Europe, are certainly more similar and different to the experience in the US and maybe even the UK, so the Anglo-Saxon model. Would you say that's fair?
Absolutely, no, that's absolutely fair. Asia we have very good experience investing in Hong Kong. We don't invest in mainland China directly, it's for many reasons. But through Hong Kong, where we feel today as a domestic market in a way for us, I have to say that we have a person there, which is a correspondent to Varane, which is a Chinese national, who helped us through a few things. but generally speaking, we managed to get through the same kind of due diligence processes with different tools, but the same kind of results that we will get in Europe and the United States. But it's also true in the other way around. For example, if you want to build a cost structure of a company, while you were, like going back to the value chain of analysis of Michael Porter, and you want to see the cost, as we say, by nature, personnel and I don't know, purchases and so on and so forth. It's probably more difficult to do that in an Anglo-Saxon environment than it is in continental Europe, because in continental Europe, companies tend to give you the splits, I will say, between the different cost structure, whereas in the different cost items, whereas in the United States, you have this large SG&A, for example, without entering into much details, and there you have basically everything. So it's the level of disclosure, it's astonishingly poor in that respect. So you have a lot of disclosure, but maybe you need a little bit more data that you have to. So every region has its own, I will say, characteristics, and you have to adapt with the analytical tools, with the background checks. For example, we're not that badly equipped with background checks, especially in Asia. It's not that Asia requires background checks more than everything else, but it's probably the culture is different from us, so we like to do background checks, especially when you have one main shareholding or shareholder leading the company. And so you have to adapt, but the principles are the same, global principle, but local practices, I would say.
Just curious on the background checks, is that really, what's the focus there? One often hears about these let's say, transactions, related party transactions in Asia. Is that designed to pick up on that?
It's much more common. It's absolutely one of the things that we look at, and there is a lot of ways, to favor larger shareholders vis-a-vis minority shareholders, and that where you have to focus. It can be through the connected transactions, connected parties, or it can be done in different ways. We have seen cases in which the listed company was not the whole of the kind of a galaxy around it. So you have the same owners can have sister companies elsewhere, but I don't want to say, because it would be unfair to say that that's typically geographically Asian, let's say, component. That's not the case. It can be the same for Europe. It can be the same for in the United States. It's probably more common in some regions and less in others. And so it's just an example of how you need to adapt in the due diligence process, while at the same time using the same universal principles. Again, without entering into any details, that's something that you can do in the regions where that's probably more appropriate.
And you mentioned also the importance of management in our conversation earlier. Certainly, one does come across a lot of great operators and even some great capital allocators in Europe and in Asia. So, in a sense, those are great opportunity sets for an investor looking for great businesses, great managements. But there seems to be this perception that there isn't much of that in Europe or Asia, and there tend to be these corporate governance issues. So, along the lines of what you were referring to as, in a way, it's not fair to label it as such.
No, I think you have, corporate governance issues everywhere. And again, I personally believe that a public company maybe doesn't have what you could consider a corporate governance issue, but still has, and we've seen many public companies engaging in large acquisitions that could really create no value for the shareholders, and because there was no kind of counterweight at the same time. So I sometimes prefer a family owned business where you really think long term. You don't try to make huge acquisitions because basically that's where a management team with no control, will see excitement rather than the public company. And that so every without entering into this area, this geographic area is better or easier or safer than the rest. We really think that every geography has its own characteristics, and while you should keep your principles universal, you should really adapt. An investor should adapt the tools, the analytical tools, and the due diligence to each of those areas. Without giving any, I would say, positive or negative valuation to any of those aspects.
Now, Giuseppe, you've been in the business for many, many years, successfully investing globally with quite an unconstrained approach and the structure that you've described. Give us a sense of, in your experience, what do you think are some of the biggest mistakes that investors make in investing?
Yeah, that's of course it's very, very big as a question, but I can talk for ourselves. The mistakes that we made have been, I would say, as Buffett will say, of commission and omission in a way. And we commit mistakes. We always do. It's our business to make mistakes. We just need to make less mistakes than others in a way. And I would say the biggest mistake is not to learn from mistakes. That's really the most important thing. You have to learn from mistakes. We have something that I learned from Soros is to forgive yourself your mistakes. Otherwise, you will not be at some point able to learn from them. So that's very important. Forgiving your mistakes is a very good piece of advice that I received, and I think I can pass on at the same time, and it worked well. And it's of course something that works for you and for the team. And of course, this is something that is not easy to do when you're starting a business. Well, we wanted to create the conditions for a team to come here, and young people, young analysts and investors coming together, creating this kind of culture of analysis and dissecting facts in a way in order to get the right answers and building on those answers to invest globally. And that's an ongoing process, and you can't do that without accepting mistakes from you and from the people that work for you. Only thing you have to ask them and yourself, I would say, to really learn from those mistakes.
That's great advice, and I'd also be curious about your advice to emerging managers, people who don't have the experience that you have and who don't have a team of people and so on. How have you, what was really the key to your success as an investor in building out that team and the firm as you've described it?
It's I think the most difficult part, going back in time, is really to, at the same time, building a company and running a fund or portfolios. Basically, you are having, I don't want to say it's impossible, and I really encourage young people to try to create something and pursue their business ideas and investment approaches within their own company. The only thing you have to be aware that you're doing two jobs at the same time. You're actually in a way building the car that you're running. So with one hand you're actually building it, and with the other hand you're running it. You're driving it. So it can be complex in that respect. And it was for us. It was much more difficult than we thought it would be. But it's also, if you go through that and you grow stronger in a way, and then that's where you probably learn at the same time that being a successful investor is probably, as Buffett often said, being an entrepreneur is probably something that helps a lot understanding the objects of your investment, which is the companies, the enterprises. So going through some difficulties at some point there will probably give you a very different view on the companies that you're investing in, and on judging the managers for what they've done and for the tailwinds and the headwinds that they will certainly experience.
Well, on that note, Giuseppe, I want to thank you so very much for taking the time to really share your experience and this approach of yours with us that really is intellectually very open-minded about taking in various best practices and being open to many different approaches and instruments in delivering value to your clients. Thank you very much.
Thank you very much, Oliver.